All right, let's go ahead and talk about some of the other liabilities that employers have with regard to their employees. We touched on this kind of at the end of the last video, and I decided that we would just stop there and kind of go over this slide again. So we have these things called fringe benefits that an employee may receive. I've asked in another class, I've asked the question before. You have two jobs, all company reputations the same, distance from your house is the same, workload is the same, prestige is the same. One pays 60,000, the other pays 58,000. Which one do you take? Well, it depends. That job that starts off at 60,000 has got a $2,000 head start, but we have to consider fringe benefit items that could potentially push the lower paying job ahead of the higher salary job. For example, employers incur liabilities for vacation pay, time that you are not going to work, that you're still going to be paid for. Now, you say, well, that's already included in my salary. Well, yeah, it is, but what if you get 2 weeks one place and 3 weeks another? We talked about medical expenses. Maybe you're a part of a group plan, and let's just say you have a family, and the total cost of that health insurance might be $25,000, but your out-of-pocket cost is only $5,000. Well, you've got a $20,000 fringe benefit, a significant fringe benefit in the form of medical insurance. And then retirement benefits. You may have the job that pays you $60,000 a year might have a much lower percentage match that they'll contribute to your retirement plan. Okay, so but regardless of which of those two jobs we were to accept, the fact of the matter is that these items represent liabilities on the part of the employer. Okay, so and it says here the cost of employee fringe benefits is recorded as an expense by the employer. With regard to these expenses, these are all still payroll related fringe benefits. I mean, when we talk about medical insurance coverage, for example, that's generally processed through payroll. So, but just understand that whatever it is, that that $20,000 a year, I gave you the example of the group plan that costs $20,000 and the employee only pays $5,000 of that. Well, we've got some liabilities there. We have a liability to the insurance company, don't we? $5,000 of that's going to come out of the employee's paycheck, and it's got to be remitted to the insurance company. And then we have to kick in as an employer the other $20,000. Okay, same thing with retirement benefits if we do any kind of matching. All right, so talking about vacation pay, recall that we are dealing with the accrual basis of accounting. So it says to illustrate, assume that employees earn 1 day of vacation for each month worked. This is kind of on average. The estimated vacation pay for the year ending December 31st for this particular company is $325,000. And the entry for the accrued vacation is as follows. We're going to hit vacation expense for the full $325,000, and we're going to have vacation pay payable is our liability. So I want you to understand this is a little bit misleading, or it could be misleading or confusing, in the sense that I want you to understand just because we're doing this on December 31st does not mean that we have paid out any money whatsoever. We're simply saying, okay, based on the number of employees we have, the average rate of accrual, average salary, and so on, that we have estimated that we are going to pay out $325,000 in vacation pay over the next 12 months. It may not be exactly 325,000. In fact, it almost certainly will not be. But we're going to set this up as a reasonable estimate. So this vacation pay expense, is going to go over to the income statement as a operating expense, which is going to have a negative impact on our net income. And then this vacation pay payable is going to be over on the balance sheet as a current liability. And then as we take vacation, this payable is going to go down. So we've got a little example here. It says this is probably could be set up a little bit different. We've got basically this is kind of a generic bare bones journal entry, and our debit and our credit are perfectly aligned here. So that's kind of a problem, but just stay with me. I think it'll be okay. It says when employees take vacation, the liability for vacation pay is decreased by debiting vacation pay payable. So yes, if we have a payable, we set it up with a credit. If we're going to decrease that payable, we're going to use a debit. Salaries or wages payable and the other related payroll accounts for taxes and withholdings are credited. So imagine, if you would, this $500 here. Pretend in your mind that it's right over here, okay? So we set this, this vacation pay payable was originally set up as a credit. Now the employee has taken it to the tune of $500, so we're going to debit that amount off. All right, so in our previous example, 325,000, let's just say this was the first employee that took any kind of vacation. Now this liability is not 325,000 anymore, it's 324,500. And then we're going to credit wages payable because it is increasing by that same $500. Remember, just like regular wages, we haven't made the actual payment for the vacation pay yet, so we have to credit wages payable to set up that liability. All right, and then we move on to pensions. This is another fringe benefit. It says a pension is a cash payment to retired employees. Pension rights are generally determined or they are earned by employees as they work based on the employer's pension plan. And as you move on in accounting, you will learn far more about pension plans. You may even take a personal finance course or something like that along the way, and those should be covered in there. It says there are two basic types of pension plans. They are defined contribution and defined benefit plans, and they are very different. So in a defined contribution plan, this is the most common of the two. The company invests contributions that have been withheld from the employee's pay, as well as any matching that they have made on the employee's behalf, and they invest those into a qualified fund. So it says here, normally the employee and the employer contribute to the plan. This may or may not be an equal amount. Then finally it says the employee's actual pension depends on the total contributions made and the investment returns earned on those contributions. So I want you to understand here, this is not really meant to be a lesson in defined contribution plans, but I want you to understand, let's say that the employee makes $1,000 a week, and they decide to set aside 3% of that, which would be $30, and the employer matches that in full. Let's just say the liability is the $60. $30 that you withheld from the employee's paycheck that you need to put into that qualified plan, plus your 3% or $30 matching. Okay. This part here about what the employee actually gets, that's way down the road and doesn't have anything to do with current liabilities. So here we have an example of this. Now this is an example, I kind of gave you one already, but Heaven Sent Perfumes, they contribute 10% of employee monthly salaries to an employee's 401k plan. And it says, assuming $500,000 in monthly salaries, the journal entry to record 10% of that would be as follows. Pension expense, $50,000, that's our debit. Cash is credited for the $50,000. This 10% is extremely high. That's not very realistic. But this is all there is to it. We would actually set this up. We could do this a couple of ways. We could set it up like this. We could say that we have a pension expense for $50,000, and then we have we're probably not going to make this payment immediately. So originally this would have probably been a payable here, and then later the cash would be credited, and then whatever pension payable we had would be our debit. So this is not really a very good example here of a pension liability, because we're recognizing the expense and we're paying it immediately. Just do understand that there would normally be a lag in this, and so probably the better entry here to set this up initially would be pension expense for $50,000, and then some kind of payable for that pension for the other $50,000. Then we would go in and reduce the payable when we actually paid the cash, probably at a later date. A defined benefit plan is a little bit different. Skipping back just for a moment to defined contribution, what is defined? Well, it is the contribution that is defined. So this $50,000 may go down in value, it may go up in value, we don't know, but that's what's going to determine how much the employee gets. Now, a defined benefit plan is a lot different. It's far more complex in terms of the accounting for it. Not so much for our purposes in this class, but it is a lot more work to do from an accounting perspective. It says in a defined benefit plan, the company pays the employee a fixed annual pension based on a formula. And the formula is normally based on such factors as the employee's years of service, age, and past salary. So here we're saying, okay, we are defining how much you're going to actually get. And one way or the other, we have to make sure you get that much. So a lot more complicated. So here we have an example that says, to illustrate, assume that the defined benefit plan of Hinkle Company requires an annual pension cost of $80,000. They have used a formula and come up with the fact that they need to be able to fund this pension at a rate of $80,000 a year. Says further, this annual contribution is based on estimates of Hinkle's future pension liabilities. On December 31st, Hinkle Company pays $60,000 to the pension fund. The entry to record the payment and unfunded liability is as follows. So we've determined that the cost is going to be $80,000, so that's what we're going to record. And we're only putting $60,000 into it. And so we have, so we can only credit cash for $60,000 because that's what we have put into it. So our liability is this unfunded pension liability. Now, what we're hoping is that our investment of $60,000 that we basically put out there into the stock market and the bond market and so forth bridges the gap here. Or maybe we just don't have $80,000 in our account right now that we can afford to pay into it. But this will be the journal entry for a defined benefit plan. We have with the contribution plan, we paid the money based on a percentage and we were done. Here we're going to have an underfunded or overfunded liability account that we're going to have to deal with. Okay, I think that's good enough for fringe benefits, and we'll pick up with another video after this.